Welcome to the latest edition of Talking Data. Our Talking Data series seeks to offer timely insights into macro market themes along with macro data and its impact on the economy and markets. I'm Kristen Radosh of Arbor Research and Trading, and I will be your host today. Our presenters are Jim Bianco of Bianco Research and Ben Breitholtz of Arbor Data Science. Today, Jim and Ben will answer the question, are risk markets ahead of themselves? Jim, we're going to get started with you. Is the stock market overvalued? Does this even matter?
To the first half of the question, I think that the answer by most metrics is yes. It's whether you look at market cap to GDP or PE ratios, cash flow, EBITDA to enterprise value, take whatever metric you want. You're in the upper deciles, if not at new highs across the board. So there's really, from a valuation standpoint, which is why I think value managers are having such a difficult time, or were, we'll talk about that in the next bullet point, is that it's hard to say that the stock market is cheap. Doesn't matter. Now that's really the question of the day. Does it matter? Because there's an argument to be made that the market is living in the second half of 21. The second half of 21 is widespread adoption of a vaccine, a permanent reopening of the economy as the R0 goes below 1, and everybody goes back to restaurants and entertainment venues, whether it's sports stadiums or concerts, back to the office. Now, we don't know how much or what degree, but we're not going to be sitting at home in sweatpants 5 days a week, kind of like I am right now, but we'll let that visual go. But I think that that's where the market is basically living right now. So when it looks at the current valuation, it says, yes, by historical standards, it's overdone, but wait till you see what's coming in the second half of 21. Ben, what say you?
Well, dispersion was really high, more than people gave it credit for, up until just very recently, the past 2 weeks or so. So again, if you look at like your going out stocks, which would include everything from cruise lines to restaurants and so on, those have lagged significantly, but have just finally started to find, kind of fresh air on the year in terms of year-to-date return over the past couple of weeks, thanks to the vaccine, election uncertainty fading, and so on. Most of the overhyped or maybe the overvalued situation is, is more on the tech side or these staying in stocks, everything, from Zooms to home furnishings, Home Depot, and so on. And I think I'm with you, Jim, that everyone is looking into the second half. They're looking past potentially some slowdown in the job market like we've just seen last week, and that we'll likely see in December. Even if we get a flat number in December, that wouldn't be the most horrible thing. It's just a matter of tiding us through and getting us through to next year. And now we have the murmurs again of stimulus, which again will hopefully patch the economy until things can really get going with the vaccine. So in terms of valuations, it's always hard to really put a number on it, and that the dispersion situation is going to close now that we have the vaccine, with everyone looking to the second half of next year. So I'm not surprised to see these going out stocks, which are a lot of the value space potentially, going to converge with tech and then also industrials in the weeks and months ahead.
The one thing though that does bother me is we know vaccines are coming. We know the market's living in the second half of 21. But if you look at whether it's real GDP or S&P revenues or earnings or any of the forward metrics, job growth as well too, whether, what are economists and analysts projecting for the second half of 21, and it's kind of meh. They're not, they've got GDP growth in the low 3s. Now, normally that's a pretty good number, but coming off the pandemic, that's kind of eh. They've got job growth in the second half, payrolls estimated to run at around 300,000, 400,000. And that's not going to get us back to reducing those 10 million lost jobs for many, many years. They got earnings growth. Excuse me. They got earnings growth coming down quite a bit, but positive positive. I mean, second quarter to second quarter is going to be plus 60% because that's the lockdown to not lockdown, but decent, but nothing great. So what you see is the Dr. Jeremy Siegels of the world saying, history has shown us that Wall Street overestimates the future, and that whatever they project a year out always comes in lower than expected. And that's absolutely true. Whether you talk about earnings or revenues or even GDP to some extent, they almost always overguess those. But now they're severely underguessing the second half of 21, to which I've always asked why, because it fits your narrative? Or why do we think now, after 40 years of always overguessing, are they going to underguess? Now, I'm not arguing that's wrong. I'm just saying that's, to me, is kind of the problem I see. We know the second half is going to be better, but yet it's not being incorporated in the numbers. Now, maybe, last thought for you, some people have argued that analysts live in the next 2 quarters. They're more concentrating on the fourth quarter and first quarter earnings estimates. They haven't gotten to the second half of next year. I get that. But this is different in that everybody's focused on the second half of next year. That almost seems to matter more than what you think the fourth quarter is going to be right now. We know the fourth quarter, the technical term is it's going to suck, so get past that. We want to know about the second half of 21 and what that's going to be. So that, to me, is kind of the one thing that bothers me about this whole thing. Yes, the market's overvalued. Yes, I can see you wanting to, but get beyond that, wait till the reopenings come. But why aren't the analysts getting super bullish with their markups on the second half of 21 when the reopening is supposed to happen? It's a mystery, and we'll see how that one plays out. Ben, any final thoughts on this bullet point?
Yeah, I think that, fine, they're too pessimistic for the second half of next year, but I think, there's a lot to be positive about in regards to savings from the CARES Act and just the degree of savings that was done, beginning in April through really the late summer months. There's $1.4 trillion in savings that can be spent. So we have over 70 billion a month that could be unleashed on the economy. That's a decent amount of padding. And we throw in another stimulus bill here, even if it's, just shy of $1 trillion. I think that the consumer will not show necessarily a significant setback that a lot of us really thought would happen. Everything expired in July with unemployment programs. So I think that, until the consumer shows some problems and a slowdown in their spending behavior, I think that things look pretty good. And for the most part, too, we're going to see this next year is going to be a weird year because we're going to see this transition from this goods economy, which is kind of bizarre. And you've talked about this, Jim, too, how we're buying stuff like we hadn't for previous years, and a shift back to services. And I think that again is going to be kind of a key shift that will be healthy, but also cause a lot of confusion. And maybe this is what's causing confusion for a lot of analysts looking to the second half of next year. That's also going to be the thing that would spawn inflation and a whole bunch of other things, since services are 75% of CPI. So it's, again, the valuation topic is a tough one. I think there's a lot to be positive about. Yes, I'm skeptical of the tech space. I would rather be looking to the going out stocks and certainly the industrials that have this strong wave of commodity prices rising. We have over 70% of economies now growing across the globe, led by China. I like the industrial space more than I like the tech space at the moment.
Our next question is the historic rotation from growth to value justified?
Yeah. So this rotation, I think that the rotation is going to come. I think that a lot of the, not necessarily the growth value, but again, getting into the going out stocks, services based, both in the commercial and the consumer space relative to goods, we're going to see this transition. So on one side, you have the goods that we've been buying, the Home Depots too, that have been selling all these home goods, as well as then furnishings, that you're probably purchasing yourself to furnish, to upgrade your homes like we've all been doing. I think we'll start to see some kind of setbacks there as we move further and further outside of our own homes. And as we do that, those services are going to perform quite well. Now, at the same time, there's a large inventory rebuild that needs to be done and more stuff that has to be produced. So on the industrial side, where there's potentially a lot of value too and value stocks, they're revving up pretty quickly, and that's led again by China. And we see that within the search activity that we track. Our colleague Peter Forbes was just on TD Ameritrade talking about the upswing in all types of different types of industrial, both services and goods, all the way up to finished goods. And that includes everything, from metals and mining and out to factory automation. And those searches have been rebounding quite appreciably here in the past couple of weeks, which is a positive and such a tailwind going into the early portion of next year.
Yeah, on growth value, I think November was a historic month. The Russell 2000, which excludes the FANG stocks by definition, and a lot of the high-flying tech stocks, because they're in the S&P 500, if not the mid cap. But the Russell 2000 was up 18% for the month of November. Its best month ever. Now the index started in 1979, but nevertheless, its best month ever. The S&P was up almost 12%, its best month since 1987, and the MSCI World Index had its best month since 1975. So you got to go back 45 years in terms of that. And what drove that was this massive shift in like one day on November 9th, when the Pfizer announcement came out of the vaccine, and then everybody, like Ben, you were saying, that there was this big move. We're going to stop buying bicycles and we're going to go start buying airline tickets. We're going to stop buying this stuff. We're going to stop buying sweatpants. We're going to go buy suits again. That kind of shift, all of a sudden in one day, started to move. And that's the nature of this market, because I think this market is being driven by two things. One, it's being driven by algos. So, even on the payroll report on Friday and the like, before it's done pixelating on your screen, the algorithms read what the stories say and fire off a whole bunch of trades, and the market instantly moves on a lot of that move. So what you would normally get as a rotation that might take weeks or months, as traditional managers have their investment committee meetings to ponder what the new news means and how to position for it, happens almost instantly, is what you've seen there. And second of all, this is something we've been writing about, for the last week or two quite a bit. The collective of mutual funds and ETFs, the collective, have been seeing outflows. Now, within that, that's huge outflows out of open-ended mutual funds, active managers, and that's inflows in the ETFs, passive managers. And the passive, they're still getting inflows. They are slowing a little bit, but they're still in total top line getting inflows. But where you're really starting to see the flows really break is into individual stocks. Now, it's hard to measure that. We don't have real measures of how much did the public buy of individual stocks. But if you look at the statistics coming out of the brokers like Ameritrade or Robinhood or E-Trade, Interactive Brokers or Schwab or Fidelity, their business is just gone gangbusters as everybody's been plowing in to buy stocks. The options market, I've been just calling it a full-blown mania between the volume and the types of trading, with small traders dominating that market over large traders being individuals dominating it over institutions, so that the public is really coming into these markets in a big way. And that, I think, has helped to foster that big rotation from growth to value that we saw in November. But like I said, my fear is, yeah, that was a great trade, growth to value, but you had to have been in it on November 8th, because it was done with by about the 10th or the 11th of November, because it was such a massive move in such a short period of time. Welcome to 2020. That's how the market seems to work right now.
Our last question for today, as we wrap this up, are credit spreads too tight?
And you do some good work on credit spreads. Why don't you tell us where we are with all of that?
Sure. So, for me, looking as far out on the risk side, we can look all the way out to like the triple C's, where there were there's a big blowout in spreads in March. They've essentially raced back to the long-term median relative to triple Bs, just I think through 2 weeks ago. And that was kind of the big event we were for in regards to saying that this reach for yield, this reach for risk was likely hitting some kind of barrier. And so I think that's kind of one step there, or one indication that this big leap for the high yield space for risk and yield may be behind us. The other thing too is that is kind of nerve-wracking is we're getting this abnormally extremely low implied volatility, both in the investment grade space and high yield. And at the current moment, high yield like HYG, JNK, and others, their implied volatility on a 1 month basis is equal to, if not less than, LQD, the investment grade space. So that means that investors are pricing in the same amount of risk, volatility. I think it's right around 7% or so on a 1 month basis, which I think is somewhat problematic and concerning as we do push into the end of the year. We're going to lose some Fed programs. And again, the stimulus bill, yes, it'll come in and help, patch some things up, but the bankruptcy wave is not necessarily completely completed. And I think that the Fed's essentially premium reduction within the high yield space and investment grade space is kind of back to the same amount of kind of weight that we had seen in late March into April. And I don't know if that is exactly very comforting. I think that the risks are larger than that. Again, there's still plenty of dispersion within the S&P 500 or 1500. And I think time will tell, but I would not be betting on a risk to get that much lower. I think that things at some point here are going to open back up, and the high yield space will see wider spreads. But investors keep piling in. I mean, investors piled in over $5 billion into high yield credit just over the past month, and that's a big kind of comeback after getting demolished for the most part in terms of flows into the end of October. So that euphoria that Jim's talking about is also certainly still present in the high yield space and in the institutional community.
Yeah, I agree with a lot of that, and I would emphasize that when the emergency 13.3 programs were pulled back by the Treasury, and so the corporate bond buying program, the ETF program were ended, people like me have argued that, well, they were supposed to be temporary programs. That's the way that they were sold, and Congress voted on the bill that they were supposed to be temporary, and they were supposed to end in September, and then they re-upped them to December, and then they ended them, and everybody acted shocked, like, wait a minute, this isn't permanent? It's supposed to be permanent. And I've said, Congress could come back in 5 minutes and re-up those programs should they be needed. Now, that's a fancy way of saying you have to get severe pain again in the credit markets. And then once you've endured a lot of pain, then your hope is Congress re-ups these programs, and here comes the Fed back to save you again. But first, you have to go through pain. This isn't going to be that, we're going to go to all-time tights of spreads, and then we're going to go a little bit tighter, and then Congress is going to come in and say, okay, Fed, bail out the market so we could go even tighter without ever having any pain again. So that's, I think, part of the problem. But I agree with you, Ben, that given that first you need to have that widening in order to drag them back in. I'm talking about when and if that happens, not that it would. The implied volatility in the risk market is completely askewed because I think a lot of investors are still co-investing with the Fed, that these markets are safe because the Fed will bail you out, like I said, without any pain first. And second of all, don't worry about all the dicey credits, the airlines and the cruise ships and everybody else that's kind of, 1 foot on the banana peel. Don't worry, there's going to be a stimulus package that's going to keep them afloat. So just keep buying them as well. So Carnival Cruise did another offering. Boy, it was just a complete blowout. People couldn't stand in line fast enough to get that offering as well too. So we're seeing that. And so I agree with you. Where are we going to go from here on credit? And I mean, if you look at the nominal yields on credit, the high yield is 4.25. That is the nominal yield on credit, 4.25, and it's 2% or so on investment grade. It wasn't that long ago that those were considered low Treasury yields, and now that's what you're getting with taking a lot of credit risk right now. And as you mentioned, Ben, we haven't had the bankruptcy wave yet. So I think that of the risk markets ahead of themselves, I'm personally a little more worried about the credit markets being ahead of themselves more than I am about the equity markets being ahead of themselves.
Well, thank you, Jim. Thank you, Ben, for your thoughts today. We appreciate it. And thank you for our audience for joining us. As a reminder, Arbor Research and Trading is an institutional research and brokerage firm. Our two most prominent research offerings are Bianco Research and Arbor Data Science. For further information on Arbor Research, Bianco Research, and Arbor Data Science, please contact Gus Handler at gus.handler@arborresearch.com.